As part of this video, try to keep it brief, but I'm going to go over basic overview of the Solana ecosystem, bridging, liquid staking, and then I'm going to walk through three different dApps or protocols on Solana that are that, like I said, have teased airdrops or have point systems set up to reward on-chain activity. Those being Drift, MarginFi, and Kamino. And then, if there's time permitting, I might go a little bit deeper into Drift and some of the other earn strategies or opportunities on their platform, since they seem to really be an up and comer here in Solana, and it's pretty exciting to see. It's a good platform, and one that I've used quite a bit over the last month or so, or 2 months really. So with that, I'll get started. Basically, the DeFi Llama protocol list for Solana here. Marinade, that's where we're going to do our liquid staking. With basically, we'll swap into Solana tokens from USDC and drop those in Marinade to start off the process. Jito is another liquid staking platform, and so is Blaze. Blaze produces BSOL, Jito Sol, Marinade MSOL. And all three of those are derivatives of Sol, obviously. They trade at a slight premium to Sol because they've earned staking rewards over time. And they have depegged in the past, but generally those depegs close relatively quickly because every token of, for example, every MSOL is redeemable for Sol tokens on their platform. Let's see, Orca and Radium are the top dexes on Solana. Radium being pretty much where all the shitcoins list. Orca being, just having a little bit more liquidity and pretty much the best place I find to swap Sol, getting good prices there. Jupiter is a good place to start. And I guess, taking it aside, I did put together a spreadsheet that has links to all these protocols in case it's useful. It's been shared in the HFA Discord. And Psyche can share it with this video if he likes, as far as the link. So there's some links in here. Some of them are referral links. If you don't want to use a referral, I've included just a regular link as well. Just kind of leave that up to you guys. Jupiter's the starting point for bridging. Generally, they have a bridge compare. So if you want to bridge $10,000 from Ethereum, you can put it in there, and it'll give you the best bridge option as far as slippage and price action. And there's obviously options to come in from like Arbitrum, Optimism, and other chains. This is also the place I generally start when I do swaps, because it routes the swap through various, just to make sure you get the best price. So just to get things kicked off, we'll go ahead and swap in basically half of the portfolio into Sol tokens. Oops, I had to do 2016 here. So we'll swap these. And then another aside, as far as there's several different wallets available for interacting on Solana. I choose Solar Flare. It hasn't given me any trouble. But there's a few different options if you want to choose those. So I guess swapping through, I just swapped $1,000 into Sol, and then we're going to take the first step is going to be to stake that $1,000 worth of Sol on Marinade, which is, again, there's also the Jito staking and Blaze liquid staking platforms. I just choose Marinade because it was the top one. No particular attachment there. But you're going to click Start Earning, and I'm going to choose, let's see, because I wanted to hit right around $1,000. So 5.5. That should give us enough. Yeah. Okay. So now we've got $1,000, 1,000 USDC, and about $1,000 worth of MSOL, and a little bit of Solana left for gas. Okay. So the first step in our airdrop farm delta neutral strategy was the bridge tokens. I use MineSwap, or you can use the bridge aggregator from Jupiter. I do think that Jupiter, that they have recently done a airdrop, but they've teased at future ones based on additional activity on their platform. So I just use them for swaps and bridging sometimes. So we swapped the SOL, we deposited in liquid staking, and now we need to set up a Drift account. So we're going to go over to Drift. I've got, in this case, my referral wallet up there. I'm going to connect the SolarFlare, and then it's going to ask me to essentially in order to create an account, it's going to cost, I think it's 0.05 or around there, SOL, which is used for the protocol rent on Solana. So we can either bridge funds, we can deposit here, let's see, but essentially this is the account creation process. Create an account costs 0.0497 SOL, and I understand the risks. We are, as part of our process, going to deposit $500 into Drift as part of, I guess, step 2. So we'll just do that now. Put this in here. We'll set up our account. So this is basically gas plus the startup fee. A few seconds. Okay, from this point on in the video, I'm no longer going to be doing the live demo. I'll walk you through each of the steps, but I attempted to do it live and realized that I was having to do calculations for health factors, and transactions were taking a while to confirm, and so in the interest of time, it's probably easier just to kind of walk you through the steps instead of do each of the steps individually. So from here, we've set up our account, and we want to go to the Earn tab in Drift to lend and borrow, and kind of the fundamental similarity between each of the protocols we're going to use here, and the strategy is really just focused on the money market at this point. I'll touch on some of the other opportunities at the end of the video, but essentially what we want to do is come into the Drift Earn tab here. We want to supply USDC and all of our MSOL, which is around $1,000. And in this case, if you look at the SOL airdrop Excel file that I shared, we start with a deposit in Drift of $700, which gives us just about enough health level to borrow $1,000 of SOL. This is actually needs to get updated here. I did make a few changes, just again trying to maintain the right health factors to which type of asset or derivative that I borrowed or supplied in each of the lending markets. But in this case, we're going to start with supplying $700 of USDC and $1,000 worth of MSOL, and then we're going to borrow roughly $1,000 of SOL from the Drift money market. See, it's this 991 here, and then once we've borrowed this 11.3 or so sol. We're going to go over to the next protocol that we're attempting to farm, which is MarginFi. Again, links are provided in the Excel file, including referral if you choose to use it. No obligation there if you don't, but I just wanted to include that, obviously. And then in MarginFi, I think one of the key aspects to highlight here as far as making things easy is it defaults down here in the left-hand corner to light mode, which provides a list of all the tokens to lend and borrow. And I find kind of more the, I guess, Aave style market where you can see each of the assets kind of spread out here in one place. You have to switch over to pro mode. So again, similar to Drift, you'll connect your wallet. It'll have you sign a transaction to create an account. I don't believe that this protocol costs any additional sol to create that account, but you might have to go through like a checkbox that says yes, I understand the risks or whatever. And then in this case, we're going to deposit all of the sol or the amount that we borrowed in Drift and our remaining roughly $300 in USDC. And then we're going to borrow, and in my case, I borrowed BSOL, which ended up being an asset value of about $820, just based on the collateral weights of what we supplied. If you choose to borrow or choose to supply other collateral here, for example, so we supplied sol at 80%. If you supplied MSOL or BSOL or GTOSOL, you're gonna have to supply a little bit more USDC in order to get to an amount, roughly equal to what you contributed to take out of MarginFi and what we're going to use for our deposit on Kamino. And then as far as airdrop farming, there's a point system up here. This again is a demo wallet that I set up, so it's just only been running for a few hours today, but you can see that it's accruing points based on the lending and the borrowing activity here. So then the third protocol that we're going to do, again, so we've supplied sol, USDC, we've borrowed BSOL. Again, you can borrow any derivative, but you can't borrow what you supply. So you can't supply sol and borrow sol. We'll go over to Kamino. Again, links in the spreadsheet. So we're down to step 8. And in this case, I did add step 7B because I wanted to put sol into Kamino, just because it has a higher collateral weight. So we take the borrowed BSOL that we got from MarginFi, we'll go over to Jupiter, we'll do our swap, and we'll come back here and supply sol 9.31, or roughly the same value amount that we borrowed from MarginFi, this $810, and then we'll supply it into Kamino, and then we'll borrow MSOL, or if in your case any other derivative that you choose, and we were able to borrow roughly $415 of MSOL. If you wanted to, or you had extra USDC, you could put more USDC in and borrow more MSOL, because at the end of the day, we're taking this MSOL and we're going to, in order to, I guess, make ourselves delta neutral, we're going to swap the MSOL for USDC, so that this is a net borrow amount in our overall account, and I guess this amount here becomes a short when we sell the MSOL for USDC. So in this case, we'd have borrowed an amount that we no longer own, so it's essentially short that MSOL, but we have a higher amount supplied, so net we're still technically long until we sell this MSOL. And in fact, after we sell the MSOL, we're still going to be long overall because of more SOL is provided in each protocol than is borrowed. But we're going to make up for that in step 9 through 11, in which we're going to take our MSOL borrowed here, and we're going to swap it on Jupiter MSOL for USDC. And we're going to take that USDC and we're going to supply it back into Drift, which is our main farm target, I guess, at this point. So by depositing the USDC back in here, we get our USDC balance up to roughly $1,100. And at the end of the day, before we do any perpetual activity, I'll take that out. Currently, based on the numbers in the example provided here, we would be sitting with a net SOL exposure of long $580. And so we'll go into Drift, we'll go to the trade tab, perpetuals, and we're going to short $580 by just essentially click short, put 580 in here, and then you can either do a limit order or market order, whatever you choose, and you're going to just click short and it'll give you the prompt to open that position. And so now our health factor is 45, our net USD value is a little over $1,000 in Drift. We have a short position that is currently earning funding at around 12% on the total value of the short, not the leveraged amount. And that position is offsetting our essentially borrowing activities on our supply here of MSOL, right? So we've got $1,000 supplied, we've got $1,000 borrowed, and we have that short position to make up for the shortfall of borrow value to supply in MarginFi and Kamino. If you wanted to make sure that each lending platform or each protocol had a delta neutral spread, what you would want to do is you'd want to, for example, contribute, in this case we contributed $810 worth of SOL. We would want to contribute USDC up to an amount that allows us to borrow $810 in a SOL derivative from that protocol, which would mean that, like in this case, if we supplied more USDC here and we borrowed $810 worth of MSOL, we would effectively be delta neutral in Kamino. And then if you went to MarginFi and you did the same thing, you supplied a little bit more USDC, you got your borrowed exactly equal in value, your borrowed derivative equal in value to your SOL, then you would you'd be delta neutral here. And in our case, we naturally became delta neutral in Drift, since we've got $1,000 supplied and 985 borrowed. So you would not need the perpetual position in Drift, but it's there as an option just to kind of as a stopgap. So that covers, I guess, the delta neutral strategy, and essentially the easiest way to do it is to supply enough USDC to make sure that you can borrow in each protocol the same amount of SOL or SOL derivative that you supply, and then you just sit there and earn points towards the airdrop. You'll earn money on your USDC, which usually has a pretty decent deposit APR. You'll earn money on your staked Marinade LSD tokens, and you'll just kind of move towards getting a good airdrop. With that, I'm going to demonstrate a couple of other aspects of Drift if you want to additionally farm more of the airdrop, you can use this as a trading platform. In the Earn tab, you can do the insurance fund staking. I have some in my main wallet, some USDC plugged away here, earning, I think last month it averaged around 35%. There's some risk here because you are backstopping losses of the platform if people become bankrupt or their account value, it doesn't liquidate in time, and they're underwater. That money does get pulled out of here. But for me, from what I've seen in the last month or so of being in there, it's always been a positive APR, and there's always been more revenue than payments for socialized losses. You can the market making vaults. Taiki mentioned this in his messages or updates, that the Drift team is going to incentivize as part of the airdrop, providing liquidity through these two options. I just started doing that in my main wallet a couple days ago, and it hasn't. I think it's minus. If I put in $1,000 and it's like minus 20 cents over 2 days, so it hasn't really showed a return yet. But they do demonstrate that they've been able to keep around 100% APR and stay delta neutral over the past few months. This is additional smart contract risk, and it is managed by this other circuit protocol. So you go over here, you'd link from Drift, and then you can deposit your amounts here, and they show some of the recent results. So that's another good. I mean, it's essentially house-made delta neutral, so you don't even have to worry about that. We are taking on a little more smart contract risk. The final opportunity on Drift is the DLP pools. A few things to note about the DLP positions or the DLP pools is the way they work. Is essentially you provide liquidity, and you can do so on leverage to the market. In this example, maybe you provide $1,000 worth of liquidity to the Sol Perp, and then you take on a pro rata portion of trading activity in the perpetual markets as a counterparty to the current trading trends or the current activity. So the way that works is essentially if the funding rate, or the way I've seen it work, or it appears to work, is that if the funding rate is positive, then you're going to be assigned short positions, as a piece of each trade, and that those perpetual positions that you accumulate will slowly grow over time until the funding rate was to turn negative, and then they would slowly unwind. In the cost basis for those positions would be included the fees that you collect as a portion of those trades. So you are earning the fee revenue, but you have the potential to grow, say over a few days, a very large short position that if the market goes crazy, you'll lose more money in your perpetual market than you would have earned in the fees that you generated. In a choppy market that goes back and forth, and there's a lot of volume, but it doesn't really move far, you earn a lot as far as fees. And in some cases, if you're being assigned shorts and the market's going down like it has over the past week or so, you're going to profit on your short positions that you're assigned. What I've done to manage those is basically I go in once or twice a day, make sure, see how large the position is, and I try to keep it, for example, if I've got $1,000 in liquidity, I try to keep this short position under $500, or the short or long position. And sometimes if it looks like the market really, recently took a dive and I've been assigned a bunch of shorts, I might just close it entirely in case the market bounces. I've been relatively profitable in these pools, but I encourage you to, do your research, read the docs, ask around in Discord, and maybe it's worth another video at some point to explain further in my strategy there. But they are generally, they're gonna, the APR in my experience has been commiserate with the risk, and so I've been happy to be in them and happy to earn some really good yields off of them. The last strategy that I'll talk about is actually on Kamino. They do have Kamino does have managed liquidity pools. Their Uniswap v3 on Orca and Radium, and you can contribute. I'm in the Orca USDC Sol pool. I think it produces. It's been somewhere around 70% APR, and it's managed by them. So if the market moves, they readjust the positioning. So here it says, strategy tracker with reset, and you can enter these pools with either USDC or Sol, and you just slowly earn fee accrual over time. You do have risk of the Sol token performance, so you might want to increase your shorts on Drift accordingly. But that's another option, and those do accrue points towards airdrops on Kamino. I think that's about it. I've tried to keep it short, tried to give a lot of information. If you have questions, I'll be available in Discord, when I can, and hopefully everybody has a good experience on Sol, and we all get some nice airdrops in the near future.